Rare paper money in 1720s France, gold was king. In the early 1720s, France faced economic turmoil, but one man had an idea that would shake the world, John Law. He proposed turning nearly worthless banknotes into valuable currency by establishing a new bank and implementing a system of credit and paper money. In 1716, France's economy was struggling due to massive debts accumulated from the War of Spanish Succession. The government faced a shortage of specie, gold, and silver coins, because people preferred holding onto precious metals rather than using the less trusted paper money. That's when John Law introduced his innovative plan to establish a bank that would issue banknotes backed by both gold and silver, making them as good as metal currency. John Law started by founding the Bank Gainrail in 1716, which issued paper money backed not by gold reserves but by the French government's pledge of its financial stability and taxes as collateral. This was a novel idea at the time, and it initially worked. People began to trust these new notes and use them for everyday transactions, leading to an increase in economic activity and liquidity. But that wasn't all. John Law aimed even higher. He established the Mississippi Company, promising vast wealth from trade in French colonies in the Americas. France held extensive territories across North America whose economic potential was largely untapped. Law's plan was straightforward: sell shares to raise capital and then use that money to develop these lands and generate profit. At first, everything seemed promising. The Bank Gainrail issued additional notes to fund John Law's Mississippi Company. People purchased shares with these banknotes, enticed by the prospect of substantial profits from the company's ventures in Louisiana. However, this is where things became complicated. The company continued to issue more shares despite the declining value of existing ones, creating an economic bubble. Prices rose not due to real growth, but because investors believed they would continue to rise. This is similar to how a speculative tech startup might have no profits, but sky-high stock prices simply because people expect it to become successful in the future. By 1720, the situation had spiraled out of control. The Mississippi Company was promising substantial profits from its operations in the Americas. People began borrowing money to purchase shares, hoping for significant returns. However, there wasn't enough underlying economic value to support the high volume of banknotes and inflated share prices. So why did people keep buying? Well, human nature played a big role. People tend to follow the crowd and believe in get-rich-quick schemes when everyone else is doing it. Additionally, John Law cleverly spread misinformation about the company's success, telling tales of gold mines and massive profits that weren't true. This fueled even more speculation. The bubble reached its peak in September 1720. Share prices were soaring despite a lack of underlying economic fundamentals to justify them. People believed they could buy at the bubble reached its peak in September 1720. Share prices were soaring despite a lack of underlying economic fundamentals to justify them. People believed they could buy low, sell high, and make a fortune. However, as with all bubbles, the day of reckoning eventually arrived. Suddenly, the truth emerged. The Mississippi Company wasn't nearly as valuable as people thought. The shares had been overvalued from the beginning due to speculation and hype. Panic set in when speculators realized their investments were worth less than they paid for them. People rushed to sell, but there weren't enough buyers willing to pay the previously inflated prices. The crash was severe. Share prices fell by about 85% within months. Many investors suffered significant losses and some individuals were driven to despair. The economic impact was substantial, affecting France profoundly, and Law's reputation deteriorated accordingly. But why did this happen? One reason was the lack of transparency. John Law didn't fully disclose how the Mississippi Company operated or its true financial position. Instead, he relied on hype and secrecy to keep people buying shares. Another factor was leverage. When investors borrowed money to buy overpriced stocks, their potential losses were even more severe because any decline in stock prices led to greater financial strain. The Mississippi bubble teaches us a crucial lesson about financial markets. They can be volatile and prone to speculative excess. Even innovative ideas can lead to instability if not grounded in sound economic principles. It also underscores the importance of transparency in business operations. When companies lack transparency or inflate their profits, investors become vulnerable to sudden market corrections. So what did people learn from this disaster? They became more cautious about new financial schemes and turned skeptical of anything that seemed too good to be true. Governments also increased regulation, aiming to prevent similar speculative bubbles in the future. Now let's break it down with some numbers. Imagine someone bought shares worth $10,000 at the peak of the Mississippi bubble in early 1720. By the end of that year, those same shares were only worth about $1,000, a loss of 90%. That's like seeing your hard-earned savings vanish overnight. The Mississippi Bubble had significant impacts on economics. It demonstrated how quickly investor confidence can shift to panic and how rapidly money can lose value when not backed by tangible assets. Economists continue to study this event to understand the influence of human behavior on financial markets. To wrap up, John Law's experiment was an ambitious attempt to solve France's economic problems through paper money and speculative investments. However, without proper oversight and transparency, the plan spiraled out of control, leading to significant economic instability and a severe financial crisis. The lesson: even in well-intentioned schemes, it's crucial to maintain honesty and grounding in real value to prevent such crises from occurring. The Mississippi Bubble, associated with John Law, is a cautionary tale illustrating the dangers of speculative excess and the importance of regulatory oversight in preventing financial market collapses. This is educational and historical, not financial advice. Shares of John Law's Mississippi Company surged as more people invested in the vision of vast riches from Louisiana. However, beneath the hype lay a critical flaw. The company was generating no real profits. Instead, it depended on promises of future wealth to sustain investor interest. Law began issuing more paper money backed by nothing but the faith of the people. This created an illusion of prosperity. At its peak, the value of French currency effectively halved due to rampant inflation rather than doubling. As a result, everyday goods became unaffordable for ordinary citizens. People started losing trust in the system as prices skyrocketed and their savings eroded. The turning point came when Law was forced to stop issuing new banknotes and stabilize the currency supply. This decision triggered a massive sell-off of Mississippi Company shares. Panic quickly spread, and within weeks the bubble had burst. What were once highly sought-after stocks became nearly worthless, leaving many investors impoverished. The collapse of the Mississippi Company had significant consequences, leading to stricter financial regulations in France and influencing regulatory practices in other European countries as well. Governments realized the importance of transparency and oversight in money creation and stock trading, understanding that unregulated speculation can result in economic instability. Law's experiment influenced later economists like Adam Smith, who analyzed how markets function and why oversight is crucial. The Mississippi Bubble demonstrated that even the most innovative financial schemes can collapse if they lack a solid foundation and are not subject to public examination. Another key lesson from this period was the danger of over-leveraging and taking on excessive debt. Investors borrowed extensively to purchase shares, assuming their value would continue to rise indefinitely. When the market inevitably crashed, many investors found themselves burdened with substantial debts and holding virtually no assets to offset those liabilities. The Mississippi Bubble highlighted how rapidly public opinion can shift regarding an investment. One day investors are optimistic, and the next they're panic sellers. This herd mentality caused significant fluctuations in market sentiment that John Law could not control or predict. Subject: the Mississippi Bubble, John Law's financial experiment. In short, John Law's scheme had noble intentions but a fatally flawed execution. It illustrated the importance of clear regulations and ethical standards in financial systems to prevent such disasters from occurring. This is educational and historical, not financial advice. The Mississippi Bubble exposed a critical flaw in human behavior: the tendency to ignore risk for short-term gains. Investors were seduced by promises of quick riches, neglecting fundamental due diligence and sound investment principles. They disregarded red flags such as unsustainable valuations and speculative lending practices. Moreover, the bubble highlighted the dangers of centralization and lack of transparency. Law had near complete control over both financial institutions and state affairs, creating an environment ripe for corruption and abuse. His Mississippi Company absorbed vast sums of money without adequate oversight or public accountability, leading to unchecked speculation and malfeasance. The Mississippi Bubble highlighted the critical role of regulatory bodies in maintaining market integrity. In their absence, there were no mechanisms to curb excessive borrowing and irresponsible financial practices, allowing them to spiral out of control. This lack of oversight led to a breakdown in trust between investors and the government, further exacerbating the crisis. In addition to these systemic issues, the bubble revealed how misinformation can fuel panic and uncertainty. Unverified rumors spread quickly, leading to widespread fear and prompting hasty sell-offs. Investors often made impulsive decisions based on unreliable information rather than factual analysis or sound financial reasoning. Ultimately, John Law's experiment highlighted the importance of a robust legal framework to prevent financial crises. Regulations are necessary to establish borrowing limits, enforce disclosure requirements, and implement oversight mechanisms to safeguard both investors and the broader economy from speculative bubbles. In short, while John Law's scheme was innovative, it underscored the critical importance of transparency, regulation, and ethical financial practices. Without such safeguards, even well-intentioned initiatives can result in severe consequences for all participants. This is educational and historical, not financial advice. The Mississippi Company's rapid rise and fall highlighted the dangers of unchecked speculation. Investors were seduced by promises of vast profits from Louisiana's untapped resources, but these prospects largely failed to materialize. The company's stock price soared due to rumors and hype, rather than concrete achievements or revenue streams. Moreover, Law's banknotes became overvalued as people rushed to exchange their gold for paper money, driving up inflation. Everyday goods like food and clothing saw significant price increases, leaving ordinary citizens worse off despite the apparent increase in circulating currency. This stark contrast between perceived prosperity and real economic hardship further destabilized society. The collapse of the Mississippi bubble highlighted the dangers of insider trading and market manipulation. John Law used privileged information to profit from stock trades, while ordinary investors were left holding overvalued assets with no intrinsic value. These practices damaged trust in financial institutions and increased public skepticism about the true intentions behind economic reforms. In addition, the episode demonstrated how government endorsement can amplify speculative fervor. When King Louis XV's regent, Philip II, Duke of Orleans, officially sanctioned Law's schemes, it lent an aura of legitimacy to risky ventures. This state support created a false sense of security among investors, who believed they were protected by royal backing rather than sound financial principles. Ultimately, the Mississippi bubble revealed that sustainable economic growth depends on solid fundamentals such as productive investments, balanced trade, and transparent market practices, rather than short-term hype or government favoritism. The lessons learned from this historical event remain relevant today as we navigate modern financial markets and regulatory systems. This is educational and historical, not financial advice.